should probably just say, with an introduction like that, I should probably just say thank you very much and turn it back over to you, Helena. So thank you. And I just wish my wife were here to hear that.
I can send an email.
Okay, I've never shared a screen before.
Okay, so at the bottom, there should be a green button in the middle that says share screen next to where you chat with people.
I hit that, and then I've got lots of things on my screen.
So then pick the one that you want to share.
Right.
There you go, beautiful. Hope it's the right. Yeah, that's perfect.
You see it?
That's the one, yep, we see it.
It says taxing matters.
Yeah, that's the one, we can see it.
Okay. So I guess thank you again for this opportunity, and really a pleasure to speak to all of you today. You know, as you may have gathered from the title of my talk and from the few seconds I was on the screen earlier today, I'm a tax lawyer. I'm a partner in a US law firm. We're about 1,000 lawyers with 27 offices throughout the US. I'm a member of the Israeli bar and the California bar. At my firm, I'm assigned to our LA office, which I have not visited in about a year and a half as a result of COVID. But before COVID, I was traveling back and forth at least once a month, spending about 2 weeks a month in the States and the rest of the time in Israel. In Israel, I live in Yerushalayim, which is an incredibly wonderful place to live. And the extra blessing of being able to live in Jerusalem continuously for a year and a half for me has been just incredibly wonderful. So it's what I call the silver lining in the COVID cloud. Another part of that is that while I'm in Israel, I get to spend more time with 4 of my 7 sons and 10 of my 14 grandchildren, which is really a tremendous blessing as well. In addition, about a week ago, 2 of my sons from the States surprised us and flew out to visit us in Israel, and also arranged for a trip for us, first vacation in a year and a half. We went to Greece and to the Greek Isles, which is really wonderful. But as a result, I have to apologize up front that I really didn't get a chance to make the outline of my presentation, my PowerPoint, as beautiful as it should be. So, but hopefully it'll contain the information that you need, despite its pretty much being a kind of straightforward thing rather than a very pretty thing. That wasn't me, by the way. Wow, it even works. So taxes, our topic is taxes. And so what I first wanted to do is remind everyone that taxes have been around for a long, long time. And I thought you might be interested to see, and maybe even some of you will recognize some of the earliest references in the Bible to taxes. So the first one is Vayitein lo maser mikol. He gave them a tithe, or 10% of everything. And so I'm just, if anyone knows the answer to who that's talking about, please feel free to shout it out, because I can't see you all anymore because I'm sharing my screen. But anyway, if you don't know, that's Abraham. Abraham, as part of what he did to save his nephew Lot, he fought with 4 kings against 5 kings. And at the end of the battle that he helped the 4 kings win, he had a lot of booty. And he went to Melchizedek, who was the head priest at the time. And he said, I'm thanking God for this tremendous victory. And here's 10% of everything I've earned through the battle. So as far as I can tell, that's the first reference to taxes in our history, in the Jewish history. The second one here, V'chol asher titen li aser asrenu lach, that refers to Jacob. Jacob was fleeing from Esau, and said to God, you know, if you save me from Esau and get me back safely to my family, I pledge to give you 10% of everything I earn. And since he did come back successfully, we're not told that he did it, but presumably he, for the rest of his life, tithed. And that's kind of I guess the first real origin of tithing that we have, you know, in the Bible. Okay, next kinds of things, Truma, Maser Rishon, and Maser Sheni. Truma is what you give a high priest as a tax, and it's either 1/40th if you're generous, 1/60th if you're stingy, or 1/50th if you're average of your earnings. Then Maser Rishon, you give another 10% to the Levite, the Levi, to help him out. And then Maser Sheni is another 10% of what's left. And that what you do is you take that those funds to Jerusalem and you spend it on food and lodgings in Jerusalem and you know, imbibe all the wonderful goodness of Jerusalem. And a few others, Machatzit HaShekel, when they did a census in the old days, everybody, they wouldn't count heads, but rather everybody would give half of a shekel in, and that's how they would count the Jewish people. Maser Ani, every 3rd and 6th year, they would give the 10% instead of going to the owner to use it for food and lodging in Jerusalem. They'd give it as a gift to the poor people. And then Leket Shicha and Peah, every year you would leave from your crops to give the poor. And finally, this one I'm hoping you'll be familiar with. Vayasam HaMelech Mas Al Haaretz V'yeh Hayam. The king instituted taxes on the land and on the islands. And that, of course, is talking about Achashverosh and the end of the Megillah. Achashverosh instituted a tax on the 127 countries that he controlled. And those of you who like gematria, mas, if mem is 40, samach is 60 is 100, and v'iyeh is 27. So that's a kind of another hint that it was, he instituted the tax fairly. He instituted it on all 127 countries. And of course, many of you who listen to the Megillah every year, you know that there's a custom in some groups to not only boo every time Achashverosh is mentioned, but also to boo when Mas is mentioned, you know, because some people don't like taxes for some reason. Okay, so now going more to today, modern views on taxes. And again, if anyone wants to shout out who they think the answer is, please let me know. Who said, in this world, nothing can be said to be certain except death and taxes?
Lincoln.
Einstein.
Benjamin Franklin. Good guesses.
I knew.
Okay.
So close, guys, so close.
A very bright group here. Next. The only difference between death and taxes is that death doesn't get worse every time Congress meets.
He's a very American focus, Mr. Hess.
Yes, I apologize. Had I known there were so many people from the UK, I would have gotten some Winston Churchill quotes, which are pretty good. At any rate, Will Rogers said that. Of all debts, men are least willing to pay their taxes. That's a hard one. That's a hard one. But Trump would be a good second choice. It's Ralph Waldo Emerson. The hardest thing in the world to understand is the income tax. This is my favorite, actually.
Me.
Who would have said that? The hardest thing in the world to understand is the income tax. Albert Einstein, one of the smartest people in the universe. So I like that one. They can't collect legal taxes from illegal money.
Sounds like Trump.
Close.
Oh, that makes sense. That really makes sense.
Al Capone.
Like one of the only ones I've known who it is, actually. Him and Franklin.
The income tax created more criminals than any other single act of government.
I love that.
Wow.
I don't know, but it's great.
Barry Goldwater, not so well known, but he was a politician in the 60s on the West Coast and was known for being very, 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 very right wing. The avoidance of taxes is the only intellectual pursuit that carries any reward. Keynes, world famous economist. And finally, anyone may arrange his affairs so that his taxes shall be as low as possible. He is not bound to choose the pattern which best pays the treasury. There is not even a patriotic duty to increase one's taxes. And the answer is Judge Learned B. Hand, one of the most famous judges in US history. So with that, that was the part of our, I guess, interactive part of our talk. And so now you can all relax. And if I'm boring you, you can all go to sleep, but I'll do my best to try to make taxes interesting. And I just, by mistake, hit my thing again, so I apologize for that, but I can't get that to go backwards. So I'll just talk about ESOPs. So what's an ESOP? An ESOP is one of the kind of creative tax vehicles that's available primarily in the US, and especially works great for people who are looking to sell their business. Why is it such a great tool? It's a great tool because it allows the individual who wants to sell their business to sell it in effect to themselves, or they sell it to their employees. How does it work? The company that, let's say the individual owns 100% of his company, and let's say the company's worth $20 million. The individual sets up an ESOP, which is a kind of retirement plan, and borrows $20 million from a bank, and that the ESOP borrows that money, uses the money to buy out the shareholder, and then the shareholder has about a year to take that $20 million and reinvest in stocks and bonds. And if he does so, there's no tax whatsoever on the sale. So it can be a tremendous benefit to a shareholder who A, maybe is having a hard time finding buyers of the company, and B, even if he finds buyers, realizes that he's going to pay a huge tax if he sells it just regularly to a buyer. And this way, he can actually sell it tax-free. Now, why does the government, the US government, allow these shareholders to not pay tax on the sale? And the answer is that what happens is the company each year then pays back the loan to the bank, and the company gets a tax deduction for doing that. And as the company pays the loan back, the shares get allocated among the remaining employees. So it's basically a way of encouraging employee ownership of companies. And because of that, the government is giving huge tax breaks. And it's not that well known, but people who know about it and take advantage of it can save huge amounts of taxes. So what are the net effects of the ESOP transaction? We're finally now on the right slide. So shareholders can sell their interest in the company on a tax-free basis. The shareholder buyouts are via bank loans. So you're not even using your own money to buy out the shareholder. And the loans are low cost because here's a thing that I didn't mention. The company can deduct both the principal and the interest on the repayment of the loan. Normally the company can get a deduction for interest only. Here you can get a deduction even for the principal on the loan. So it makes the loan very low cost. And then, as I said earlier, the company employees over time will become the owners of the company. So it's really a win-win for everyone. Another thing, I don't know how many of you know about IRA accounts. It's not the IRA of the UK, so I apologize, I should have said US IRA, but IRA accounts are a kind of retirement plan that individuals can set up for themselves. And sometimes I'm confronted with a situation where a client has a very big IRA account, let's say maybe has $2 or $3 million in the account, and wants to make use of the money, but under the law, you're limited to you're not allowed to lend money to the person who sponsors the IRA account. So here, this is a technique that we've used on a number of occasions to help people in that situation. And what we do is you're allowed to roll over an IRA account into a regular company profit sharing plan. And you're also, profit sharing plans are allowed to invest in company stock. And so what we do is we have the IRA account transferred through a rollover to the profit share, a rollover account in the profit sharing plan that's non-taxable. And then the individual uses that account to buy company stock, which is permissible if the plan allows you to do that. And the key here is that the individual buys newly issued company stock, which means that the money for purchasing the stock goes into the company, and the profit sharing plan holds the stock. And by doing that, the company now has the $2 million or $3 million that used to be in the IRA account and can lend it to the individual or can pay it as salary or whatever. And so it's a way of creatively freeing up the money that was otherwise locked up in that IRA account. Another kind of technique that we use quite a bit is called the Charitable LLC. What you do is an individual, let's say, who has a significant amount of money, let's say in our example, $10 million, forms an LLC. An LLC, for those of you who aren't familiar with it, is a company that's a flow-through, kind of like a partnership, except that there's limited liability. So the LLC stands for Limited Liability Company. But what you do is you form an LLC and you fund it with either cash or highly appreciated assets. You then donate a majority interest in that to a charity. But the person who sets it up retains status as a managing member of the LLC, which means he controls whatever happens in the LLC. Now, as a result of donating that interest to charity, he gets a big tax deduction for the value of that interest. But still, as we said, he controls the amount of distributions that are paid to him or to the charity. And if once you have this kind of partnership, this LLC between the individual and the charity, then any assets that are in the LLC can be sold with virtually no tax, because charities don't pay tax on capital gains, or for that matter, any other kind of income, except with a few exceptions. And so it's a way of allowing the sale to take place within that entity almost completely tax-free. And the structure can continue forever, because when the managing member dies, well, first of all, when the managing member dies, only his small interest is going to be put in his estate tax return, and which means that most of the value of the estate of the $10 million in our example is going to be outside of his estate and not subject to estate tax. Another nice benefit. And the managing member can designate that his heirs take over in the event of his death. So this structure can really continue as long as the parties want it to continue. So again, it's a nice benefit for the charity and a really nice benefit for the person who sets up the structure. Finally, in terms of kind of tax planning strategies, often we're confronted with a situation where an individual, let's say, owns 100% of a company. In this example, we say he owns 100% of the stock of company A, and he says he would love to save money on his taxes, on the company taxes, by putting away more money for retirement. And the company happens to have two lines of business. Let's say one line of business is marketing and one's public relations. And there happens to be a rising star Y in the company who X wants to reward by giving her an ownership interest in the company. So what we do in a case like this is we restructure company A so that going forward, it's only going to serve as a marketing company, and we create company B that's going to handle the public relations. And the company B is going to be owned 75% by X and 25% by the rising star Y. And there's going to be, their salaries are going to be spread over the two companies, with the result that without increasing the costs for any of the other employees, we've doubled the pension contributions for X and Y that they otherwise would have had, without really changing anything in terms of the operations other than setting up two separate businesses. Another area that's very hot right now and that we're seeing a lot of activity in are state tax audits. A number of years ago, the federal income tax laws were changed to limit the amount that can be deducted on your federal return for state and local taxes to $10,000 per year. Now, so as an example, California has a 13.3% state income tax. And in the old days, if you were in the 40% tax bracket, you only would have really paid an effective rate of 7.98% in taxes. But now, the more income you have, the closer your tax bill for just California is going to get to 13.3%. And if you're a resident of California, you pay taxes on your worldwide income, not just on income earned in California. So that can be a really huge amount of money for high-earning, high net worth individuals. Another thing with California in particular is that California says that if you are in the state for other than a temporary or transitory purpose, and they don't really define what that means, that's enough to make you a California resident. In most states, you have to be in the state at least half a year. But in California and in some other states, it's enough that you're just in the state for other than a temporary or transitory purpose. So we've had clients who've built very nice houses in California, but have otherwise lived elsewhere and have spent maybe a month or two in California, and the state has come after them and said, as far as we're concerned, since you're not in California for just a temporary or transitory purpose because you built a home and you live here for a significant amount of time, we're going to consider you a resident. And again, as we said earlier, if you're a resident, you're taxed on your worldwide income at 13.3%. It's really not a good situation. So many families, many of our clients are moving out of high tax states like California, like New York, to states like Nevada, Florida, and Texas, which have no state income tax. The high tax states are aggressively auditing the tax returns of the families that are moving out. So it's really, really important to make sure that they've successfully done everything they can to make sure they're no longer residents in the states that they're trying to leave. And this issue happens all the time with people who have lived in California for many years. They have several homes in California. They realize, oh, we're going to pay such a high rate of tax in California. Going forward, we got to get out of here. But, we really love our homes and we still want to live in them from time to time, et cetera. And unfortunately, in cases like that, these people often get slammed and end up not only incurring all the costs of moving, but also still paying the same amount of taxes they used to because they didn't do everything they could to get out of California. Final topic I wanted to touch on is tax issues that affect new Olim. Because I know those of you who are in the UK and in Canada who are on this call and in the US, you're all thinking, I really should become a new Ole, right? That's what Helena was alluding to earlier. And so you should know about some of the tax issues that you will be facing when you become a new Ole, which we hope will be very soon. So one example, there's a 10-year tax holiday on income from the country from which you made Aliyah. So let's say you made Aliyah from the US. For the first 10 years that you're in Israel, you don't have to pay tax in Israel on the income that you earn in the US and continue to earn for those 10 years. And that's a tremendous benefit. However, you're still going to have to pay tax in the US on that income. And so it's not It's not a 100% victory, but it's still a, since the rates of tax are often going to be higher in Israel, it's still a tremendous benefit. But there's also some wiggle room in terms of when that 10-year period starts. So let's say you make Aliyah, you come to Israel, and then you say, you know, I just realized there are a lot of things I've got to tie up in the UK or in Canada or in the US, and I'm going to go back, and maybe I'll only come back again another year or two. So there's the ability, even though you've made Aliyah, to defer when that 10-year period commences. And so you want to make sure that you don't waste a few of those years because you didn't realize that you could make that deferral election. Number two, very important for New Olim to know that it's a really, really good idea to have an Israeli will for Israeli assets and a foreign will for each country outside of Israel in which you have significant assets. So if you're coming from the UK, you may or may not have a will in the UK, and you're moving to Israel, and you have real estate, let's say, both in the UK and in Israel. Really good idea to have a will in both places. A will from the UK or from the US or Canada could be probated in Israel, but it can take a long time and it can cost a lot of money and be a tremendous hassle. And an Israeli will is simple for the Israelis to handle. And so my advice, strong advice, is get an Israeli will and have a foreign will as well. Also, make sure that you become an Israeli resident when it's most beneficial. We said earlier that if you're an Israeli resident, or maybe we didn't say it, but I thought it. If you're an Israeli resident, then you are taxed, just like when we talked about with California. If you're an Israeli resident, you're taxed on your worldwide income. If you're not an Israeli resident, you're only taxed on Israeli-sourced income. So in other words, if you worked in Israel, provided services in Israel and got paid for that, or sold an item in Israel and made a profit, whatever, that's Israeli-sourced income. You're going to be taxed on that in Israel no matter what. But if you are otherwise not an Israeli resident, you're not going to be taxed in Israel on money you've earned in the US and the UK, what have you. And so really important to make sure you decide affirmatively when you're going to become an Israeli resident, because once you do, it's going to be not so easy to then become a non-resident again. And an Israeli resident is taxed in Israel on their worldwide income.
Mark, you've got about 3 more minutes. Oh, perfect. Perfect timing.
So if I have 3 minutes, let me, no, I'm only kidding. I'll let us finish 3 minutes early. Thank you so much for your attention.